Let's get things underway. Welcome to what's Donald Trump's labeling Power Plant and Bridge Day. Obviously, I think everyone's read about what the potential ramifications are of what may go and take place over the next 24 hours. For those of you who are not, though, basically Donald Trump, in the space of a 4-hour window starting from 8 p.m. Eastern Time tomorrow night in the United States, which for us here in Asia is going to be 10 a.m. in Sydney, 9 a.m. Tokyo, and 8 a.m. in Singapore and Shanghai tomorrow. Basically a 4-hour bombing blitz to go and take out all the power plants in Iran and all the bridges. That's what he's warning at this stage. But he's saying that he might do it. And that little word there has been very, very important. The way that markets so far are trading this very serious risk event. If you look across Asian equities today, you would think that Trump has already tacoed. You can see massive gains, particularly in South Korea. We've had some very, very strong earnings from Samsung. Catch-up moves as well in other markets that were closed over the Easter long weekend. But just given the risk and given how complacent we've seen a lot of sentiment in regard to this particular threat, when it comes to what we're looking at, we are talking about a major asymmetric risk event into this deadline. So what does that mean? It means that it's very high probability that Trump will taco. He will go and find out some spurious deal or making another extension, although he says he's not going to go and do that. And then the world will be able to go and kick the can down the road, extend and pretend, and risk will likely go and rally. Although, if that view is wrong, and this is the big risk, it's only very small, the probability, in my opinion, about this taking place. But if it happens, markets are incredibly wrong-footed at this point in time. If we don't see a taco, if we see a proper escalation and Trump follows through with the threat, then we've got to start to reprice a very real risk that we could go and see prolonged energy market shortages, supply shortages from the Gulf through an extended period. And I'm talking not about just the Strait of Hormuz, I'm talking about potential damage to infrastructure across the region, particularly energy infrastructure, desal plants and things like that. So the human toll is very, very real, not just the market's toll. So that is the key risk event that we're all hanging out for today. Surprisingly enough, I was expecting we might go and see some kind of conciliatory headline around about the Tokyo Open, which we've seen in recent weeks has been a really, really popular window for these headlines to come out saying, oh, some positive news. But so far, nothing has arrived. So the closer we get to that deadline, the more volatile I expect markets to go and become. So keep a close eye on the headlines today. I'll certainly be doing that in Asia. On that point, I'm the only APAC analyst in terms of the English-speaking team here. I know Jerry's on board, but certainly when you go and look around, Matt's going to be offline for most of this week. So it's going to be myself. I'll endeavor to try and get as much done as possible for you. Taking a step back, we have seen some pretty key data over the course of recent days. In the United States on Friday, we saw non-farm payrolls released, and it was pretty good. Very, very strong relative to consensus. So let's go through some of the details. When you look at the increase, it was 178,000. That was versus 60,000 expected. The prior data was revised down sharply, though, to show a drop of 133,000. For me, the most important piece of information, which just eliminates a lot of this noise that you see, is the unemployment rate. And it went and fell to 4.3%. And that was helped by a slight reduction in participation. But the 2 decimal points, it was actually 4.26. So the unemployment rate, labor market conditions in the States are still pretty tight. There was a little bit of weakness coming through in the wages measure over a year, 3.5% increase, which was the slowest since 2021. But when you look at the composition about how that took place, there was a whole bunch of healthcare workers who were returning to the workforce after strike action. And we also saw some weather disruptions as well that generally impacts lower paid employees. That probably explains that particular outcome. Overnight, we saw the ISM Services PMI. It came off the boil a little bit, 54, which is still in expansionary territory. But the thing that really caught my eye and really shows how snookered central banks are in this environment is the prices paid measure. I'm actually just going to go and bring it up on my screen right now so you can go and have a quick look. Now, what we're looking at here is a reading of 70.7, which is the highest that we've seen since October of 2022. So for those of you who are not aware what this is, it's a dispersion index. So basically it's measuring the breadth of what survey respondents are reporting they're seeing cost increases coming through. So this 70.7 figure, you can label it 70.7%. So the breadth of services firms talking about inflationary pressures building is very, very high. And this is only at the start of this Iran war. Of course, we have no idea how long it will continue. And that makes it very, very difficult for the Fed and other central banks, not just happening in the United States, but other parts of the world, to go and respond to the risk to activity from the war, which is obviously there because of the implications for inflation. So if you look at things like Fed funds futures at the moment, there's 1 basis point of rate hikes priced in. So essentially nothing is expected from the Fed over the course of this year. When you look at things like the RBA, you can see here for a May increase, remembering that of course they went in both March and February this year, we're looking at 75% pricing for another hike, which would take the cash rate back to where it was at the peak of the last cycle. So central banks cannot go and respond as they have in the past. And that's not just a story for the Fed, the RBA. We've got multiple hikes priced in Europe. We've got multiple hikes priced in Japan. And that is very, very interesting because it really makes it difficult for risk to go and rally if we don't get a positive outcome in Iran. As for non-geopolitical risk today, there is a little bit on the radar to go and look at. One thing that those in Japan are probably across at the moment is what's been going on. So you've had lots of focus on the Japanese yen as being very weak, but it's what's going on in JGB yields, which is really, really interesting. I'm just going to go and pull up this chart very quickly. This is the broader Japanese yen index, so a broader measure against a basket of currencies in the top left quadrant. And you can see here 5-year, 10-year, 20-year, 30-year, and 40-year yields. And you can see they're all starting to go and push higher. Again, there is stress in Japanese debt. The markets are saying that to account for the risk that we have when it comes to the fiscal side of the equation in Japan, given it's a major energy importer, the yen either has to weaken a lot or there has to be high yields coming through in Japan to go and justify that increased risk premium. The reason I'm talking about this today is that we're going to have a 30-year bond auction. So keep a really close eye on the result of that. It will be released at 12:35 p.m. in Tokyo. That's around about 1:30 time in Sydney and 11:30 in Singapore and Shanghai. That could have a big influence on the yen, especially if it's weak. In terms of some of the markets that I'm looking at the moment, let's go and have a look at gold. Lots of people are trading this at the moment. You can see it was in an uptrend, and then late last week we've seen this uptrend broken, and then consolidation of that move. On the downside, you can see 4,550 has previously acted as resistance and now has been tested once, and we've seen a bounce. So on the downside, that is a level to go and keep a close eye on. When you look above 4,700, you can see 1, 2, 3, near enough 4 on the 4-hourly chart here. So that is a level of focus on the top side. If that was to be broken, looking for a return back to 4,800, which was the high that was struck earlier this month. And then beyond that, there's not really a lot to go and speak of until we get back to 4,975. On the downside, which I'd imagine would come into play, we do see an escalation in Iran. 4,550 is the level to watch. Then beneath that, 4,500, and then not really a lot to go and look at until we get to the nadir that was struck in late March on the 27th of 4,353. Nikkei is another one that I've been on the radar. Let me go and pull that one up for you quickly. Actually, we'll start with we'll have a look at crude here. So what we're looking at here, this is our contract that we're trading. Okay, hang on a second. How about that? Perfect. All right, so you can see here, for all the joyous price action and risk on move we're seeing in equities, for what it's worth, the cleanest view that I've had for a long period of time as to what's going on, you can see here the WTI contract is now currently sitting near enough at the highest level seen since right when the outset of the conflict began. So at the moment on the downside, 105.85 is acted as resistance and support. That is an immediate level on the downside to keep an eye on. On the top side, you can see $112 has capped the price twice on the daily chart. So that is the level overhead that you want to keep an eye on. If we see an escalation I expect that what will happen is that this will be absolute cannon fodder, and we will retest the highs that were set back at the start of the conflict. If we see a de-escalation, 105.85, then on the downside you can see we've got this uptrend still in place, and you can see we've also got a minor resistance and support level at $95.10. So that's on the crude front. Nikkei, when it comes to that particular market, is interesting at this point. So at the moment, it's very rangy. Despite the risk coming from JGB, despite the risk coming from energy security, you can see at the moment, whenever it's tried to go and get above 54,000 recently, it's just been knocked back lower. And there's really been a range up to the 100-day moving average, which you can see here. Actually, the 50-day moving average, sorry, in blue. So you just had lots of rejections around this area. And again, we've seen exactly the same outcome today. A test, and it's been hit right back lower. So that seems to be a good area to go and initiate shorts from if you're playing it from the short side. On the downside, 52,350 is a very minor level, almost like a pivot level in between the broader range. And you can see here 51,000. Lots of bounces from this level, particularly in recent weeks. When you look at the risks around this, again, if we have an escalation, downside is much greater than upside, and vice versa if we get another taco moment. SPX is another one that I wanted to go and look at very quickly. And you can see here, we've had a downtrend that had been in place. We saw a big snapback, a corrective bounce. We tested that level for several times. And then when I last spoke to you, I was talking about the importance of 6,500 because it's one of those levels the price has done oodles of price action around either side. We went and tested that level and we bounced really strongly, delivered a hammer, and you can see we've actually gone and broken that downtrend now. So 6,600 is a level the market is now flirting with. Overhead, you've got the 200-day moving average, 6,700, which was the high that was set back on March 23. And you can see here the 50 and 100-day moving averages. So yes, we've broken the downtrend. That's alleviated some of the immediate downside risks. But when you look just purely from a technical perspective, these levels are going to be difficult to overcome unless we see some really strong positive resolution in the Iran conflict. On the downside, 6,500 still remains the key level to look at